In this week's episode, we discuss the economic calendar just before Christmas, the aftermath of the UK elections, and the trade wars, all with Bob Mason of FX Empire. Hello, Bob, and welcome back to another show of Weekly Wrap. Let's start by the economic calendar. It's the middle of the week before the holidays. What can you tell us? How are the calendars looking?
It's been a particularly busy week on the economic calendar. Plethora of stats before next week's sort of market close through the middle of the week stuff where there's very few stats to consider. For the US dollar, beginning of the week, we saw private sector PMI numbers. It was a bit of a mixed bag. We saw manufacturing sector activity slow a little bit. The growth slowed down a little bit in December according to prelim numbers. In contrast, however, service sector activity picked up. And that's all important considering the contribution to US GDP. So that was dollar positive. Moving across to Tuesday, we also industrial production rise in November, up 1.1%, reversing losses from the previous month. That coupled with a decent size gain in the job openings for October, following NFP numbers for November a couple of weeks ago. So labour market conditions look ripe and primed to sustain consumption in the US. That is obviously the main contributor to growth. So all in all, for the dollar, it was positive going into Thursday. Then we saw a softening in manufacturing sector activity in Philadelphia. The Philly Fed fell down to sort of 3.0, the index, and we saw initial jobless claims rise a little bit, but nothing to raise too many red flags in the labour market. And the markets are still accepting manufacturing sector, woes, when considering the fact that there's a phase one agreement now in place and tariffs coming off a little bit to support trade. So all in all, pretty decent week for the dollar. Trump got impeached. No one really cared. Equity markets hit record highs. Dollar held on. So he's not going to get ousted by the Republican Party. So markets are quite calm about all that. Moving across to the pound. Not great at all, really, when we consider the PMI numbers for December on Monday. A further pickup in the contraction pace. So, that was quite dire for both manufacturing and service sector activity. Then we looked at claimant counts and wage growth, which also disappointed. There was better than expected unemployment rate and employment growth, but the claimant count was key, which is a month ahead. And obviously wage growth, we need that to keep on the rise and maintaining levels that we'd seen prior to support the economy. So pretty dire. Inflation numbers did very little to the pound midweek, and then we saw retail sales figures be particularly disappointing ahead of the BOE on Thursday, who stood pat on monetary policies as we'd expected. Perhaps would have expected maybe one more dissent, but two people voted, the same two from the previous month, in favour of a rate cut. What did the BOE really look at? If economic conditions don't improve, then there's going to have to be some support. I think there's still hope that once the Brexit clarity has been addressed and we've had the general election, there'll be some pickup in consumption to support the economy. Moving across to the euro, private sector PMIs, it was a mixed bag. We saw manufacturing sector activity slow further. However, we saw service sector activity hit a 4-month high. So that propped up the euro at the start of the week. We also saw business sentiment in Germany improve, so that was a positive, and a marked widening in the Eurozone's trade surplus, particularly with strong exports to outside of the EU. So those were positives. There were no stats on Thursday for the euro to factor in, so we shift focus today on Friday to consumer confidence numbers out of Germany and Eurozone. The Eurozone number likely to have a bigger influence on the euro. For the ECB, consumption remains key, so we need confidence and wage growth to sustain. So all in all, strong dollar, weak pound. Pound's taken a hit. It's not just the data, however, and obviously the euro's managed to hold its ground despite negative sentiment towards Brexit and pretty dire manufacturing numbers.
So data releases from the US have been very good this week. Following the aftermath of the UK elections, what can you tell us? How's it looking for Boris Johnson and his push for Brexit? And how's that affecting the pound?
For the pound this week, outside of the data, British politics has been in focus. Obviously, we've got the aftermath of the UK general election and Boris Johnson's majority. So, He laid down the gauntlet at the beginning of the week. The reality is he's not going to play. He's not going to mess around with the EU. First things first, he is looking to address and amend the Brexit bill to remove any chance of an extension to Britain's transition period. So that means that whatever happens, trade deal or not, Britain will leave the EU officially by December 2020. The bill has a few other amendments in place as well, so that's going to be thrashed through Parliament later today, actually on Friday, and also in the new year. They'll have members of Parliament will have a number of occasions to discuss the content before it's put to a vote. Later today, however, one vote will take place, and that is to enable Britain to actually officially leave the EU and enter the transition period. That would be effective 31st of January. So markets took a bit of a dive, in terms of the pound. We saw the pound retrace its gains from the general election, particularly the gains that came out following the first exit polls where the pound had hit 135 levels. We saw the pound retreat back to 130, managed to avoid 129s, but it wasn't far off. It's hard Brexit. The reality is there. Skeptics have said that they are doubtful that Britain can negotiate a trade deal before the end of December next year. Johnson doesn't want to have the same experience as Theresa May and her predecessors, however, where we saw Brexit negotiations drag on for almost 3 years. And even now, we're still without any kind of trade agreement really in place. So definitely needs to be done. That should give the EU a bit of heebie-jeebies. And there's Trump sitting in the wings. Trump's threatened the EU with tariffs, and Boris Johnson and Donald Trump are pals. So if the EU start playing hardball, Trump could get involved and start threatening the EU with tariffs if they want to play hardball with Britain. So that could be an interesting, play for the markets to look at through next year. For the EU, the euro, they did sort of reverse a little bit once the threat was made. And the reality is that, it looks like this bill will eventually get pushed through with Johnson's majority. It's a first test today, however, for Boris Johnson and his majority to demonstrate that the Tories are united following the last election result. And assuming the vote goes his way today on Britain's departure from the EU, that really does suggest that whatever happens, this bill's going to get pushed through by the majority, united front. So big day for the pound today again. Expect some jitters really if Johnson gets his way and the Tories remain aligned. And the EU's going to suffer as well. It's not just Britain's that's at stake here economy wise. The euro has as much to lose as a trading partner once WTO tariffs get put in place. So quite a big day.
With all the news coming out from the US and the UK, it's a little bit forgotten regarding the Commonwealth currency. So what can you tell us regarding the Kiwi, the Aussie and the Loonie?
So for the Aussie dollar, it was a game of two halves really this week. In the first half of the week, we saw the RBA sink the Aussie, while the RBA statement earlier in the month had been a little bit more hawkish than expected, providing some upside. The latest minutes revealed that the RBA is considering reviewing policy in this February once they've got the latest forecast out. And judging by the economic data we'd seen going into the RBA meeting and even shortly afterwards, the data did suggest that some further support was going to be needed, spooking consumers or not. Second half of the week, however, we saw employment figures on Thursday in press, so that gave some much needed support to the Aussie, which continues to sit in positive territory. This morning, the PBOC held its prime rates unchanged following a cut last month, so that didn't provide too much support. But economic data out of China at the start of the week was positive, and there's a phase one trade agreement in place and tariffs are coming off. So based on all of that, the Aussie dollar should hold on to its gains going into the market close. For the Kiwi dollar, it's a little bit different. While we did see business and consumer confidence improve at the start of the week, according to the data, and we even saw the trade deficits narrow and the GDP come in better than expected for the third quarter. The jury's still out on whether the RBNZ can hold back on providing further support. We saw the Kiwi dollar give up some of its gains, through this week, and it's holding on to positive territory, but barely, following last week's upside. So we should see some pressure on the Kiwi dollar, particularly, perhaps for the Aussie dollar. We're going to need some more stats before we see that start sinking again. But it's not just going to be down to employment numbers. We're going to need consumer confidence and spending to support. So moving over to the loonie, we saw the US MCA get approved last night, bipartisan vote. That was after the initial House vote pushing it through. That's taken a year. So NAFTA's finally been replaced. Economic data out of Canada, it's been mixed, and a lot's going to hinge on today's retail sales figures. We don't see the Bank of Canada moving any in the near term. Pollers does think that interest rates are at the right level. You've got the new agreement in place. We've got phase one US-China agreement in place. So I think that's giving cause for the BOC to sit back and see how recent monetary policy moves will filter through. So it's been a big week. The loonie's held on to gains through the early part of the day. It found some support midweek through rising crude oil prices as well. So all in all, being relatively positive for the loonie as well.
Let's move on to the trade wars. How's it looking for the Japanese yen and the Chinese yuan for the rest of the weeks, given the fundamentals that have been released?
It's been a non-existent week for the Japanese yen, up 0.05% to the morning of Friday. It's been two sides of a coin, really. We've seen, easing of demand for safe havens following the US-China phase one agreement. And then we've got Brexit in play, which is providing some demand for safe havens. The risk of a hard Brexit has risen, even though Britain has an entire year to negotiate a trade agreement with the EU. Trade data out of Japan was unimpressive. Earlier in the week, we saw a trade deficit, with imports seeing a particularly heavy slide, suggesting that exports could see further decline in the months ahead, in spite of an expected improvement in global trade terms. Inflationary pressures were non-existent. This morning we saw inflation come in at 0.5%. The annual core rate of inflation up from 0.4%, but a country mile away from the BOJ's objective. So BOJ stood pat on policy. There's fiscal policy support from the government. They're going to see how that filters through to offset the effect of tax hikes. If we're looking at inflation, last month's household spending figures, things are going to really need to improve for the BOJ to avoid a much promised move. For the Chinese yuan, it's been on the back foot throughout the week. Obviously, there's been some skepticism over whether China will stand by its obligations within the phase one agreement and actually buy the demanded volume of agri from the US that's been demanded by Trump in particular, who's likely to use that in his presidential campaign to woo in the farming vote. Economic data at the early part of the week was positive, did nothing to provide support, and the PBOC held prime loan rates unchanged this morning, which was expected following last month's cut. Obviously, the PBOC is expecting some improvement in global trade terms to support growth, so they'll watch to see how that unfolds in the coming months.
And finally, it is Christmas coming up soon, so what can you tell our viewers what to expect just before and maybe just after Christmas, like a summary of some sort?
And finally, with a massive data already released, there's been some moves across the currencies, particularly the pound. Economic data through today includes, for the euro, we've got consumer confidence numbers. For the pound, we've got finalized third quarter GDPs. For the dollar, we've got finalized third quarter GDPs, plus the Fed's preferred core PCE price index numbers, personal spending, and economic sentiment numbers that are going to need to hold steady to support the dollar and its current weekly gains. Elsewhere, we've got the loonie and obviously retail sales figures. So it's not done and dusted just yet. This afternoon should prove particularly interesting again. The traders have got one last swing before volumes really slide off. A number of markets are shut through the middle of next week, so we can see particularly low volumes that are going to cause some perhaps sizable fluctuations across some of the major pairings.
Okay, Bob, thank you so much for joining us again this week. That was the midweek wrap. And personally, I would like to wish all our viewers a very happy holidays for next week.